everyone, Gigi here. And if you've been watching the market today, you already know something big just happened. A few hours ago, the Federal Reserve completely changed direction, and almost nobody saw it coming. The new Fed chair just made his first move, and it's already shaking up the stock market, the housing market, and even Bitcoin. So in the next 15 minutes, I'm going to break down exactly what changed, why it matters, and most importantly, what it means for your money. Stick around till the end, because the last part of this video is honestly the part that affects you the most. Before we dive in, if this is your first time here, welcome to Gigi Invests. I cover real estate, personal finance, and investing news. No fluff, no hype, just what's actually happening and what you can do about it. If that sounds like your thing, hit subscribe. It really helps the channel grow. So let's start with the one number driving almost everything right now: inflation. For the last few months, inflation had been slowly cooling off. People were getting comfortable. Then this week, it jumped back up to a 3-year high, with the Consumer Price Index coming in at 4.2%. That's a big number, and a lot of people online are panicking about it. But here's the part most coverage is leaving out. When you actually dig into where this inflation is coming from, it's almost entirely one category: energy. Oil and gas prices have nearly doubled over the past 6 months, driven by the ongoing conflict in the Middle East. That's it. That's the main driver. It's not random across-the-board price increases, it's concentrated in one sector. Now, to figure out where prices are headed next, economists look at something called the Producer Price Index, or PPI. Think of it as a preview. It measures what businesses are paying before those costs get passed on to you at the register. And the latest PPI numbers came in worse than expected. This puts the Fed in a genuinely tough spot. If inflation keeps climbing, they may be forced to raise rates to keep things from spiraling. But if oil prices ease up, they'll probably wait a few more months before making any big moves. And that's the tricky part. Oil can swing wildly based on a single headline out of the Middle East. One ceasefire rumor and it drops. One escalation and it spikes right back. So whatever decision the Fed makes next, the market is going to feel it fast, especially in stocks. And speaking of stocks, this next part is honestly where it gets interesting, because we just watched the largest IPO in history happen in the middle of all this chaos. Stay with me, because this connects directly to whether stocks are about to drop or about to take off. This year gave us the biggest IPO ever recorded. And on the surface, IPO investing looks incredible. One study tracking every tech IPO over $1 billion since 2010 found the average company was up 248% within 5 years. But here's the catch nobody talks about. That average is dragged way up by a tiny handful of massive winners. Take those outliers out, and the median tech IPO is actually down about 7% 6 months after going public, and still down roughly 3.5% a full year later. And when it comes to this year's record-breaking IPO specifically, it's already trading at a valuation north of $2 trillion. The companies that delivered those legendary 30x returns, they IPO'd small and grew into giants. Starting at $2 trillion leaves a lot less room to run. That's not a knock on the company or its founder. Some of these entrepreneurs have defied the odds again and again. But historically, chasing IPO hype tends to produce below-average returns once the early excitement fades and early investors start cashing out, which is exactly what's expected to happen over the next 6 months. Now here's where it gets bigger picture. A massive headline-grabbing IPO landing in the middle of what's being called one of the most overvalued markets in history has people asking, is this a market top? There's a real argument for that. Historically, waves of big IPOs have clustered right before market peaks, and right now, the S&P 500's price-to-earnings ratio sits near 40, a level only touched once before during the dot-com bubble. By some measures, the market is overvalued on 17 out of 20 standard valuation metrics, with several of those already exceeding the level seen at the 2000 peak. But, and this matters, those same warning signs flashed almost as loud back in early 2025, and anyone who panic sold then missed out on another 20% gain afterward. Markets can stay overvalued for a long time before anything actually happens. So the honest answer is, nobody knows for certain if this is the top. What you can do is avoid chasing hype and position your money so you're not wrecked either way. Now, let's get to the main event, because this is what's actually moving markets today. A new Fed chair has officially taken over from Jerome Powell, and in his very first public address, he laid out a direction nobody was fully expecting. Instead of more rate cuts, the market is now pricing in a possible rate hike sometime in 2026, with interest rates expected to stay higher for longer than almost anyone forecasted just weeks ago. Today also brought the Fed's official economic projections, basically its forecast for where the economy is headed. According to those projections, interest rates are expected to tick up slightly in 2026 before easing back down in 2027 and again in 2028. Inflation itself is projected to stay elevated around 3.6% through 2026 before gradually coming down. One more change worth flagging: the new chair has signaled he wants to scrap something called the dot plot, the tool that normally gives the public a transparent look at where each Fed official thinks rates are headed. His reasoning is that the Fed should signal less and act more. In practice, that means less guidance for everyday investors trying to plan ahead. It's worth noting, though, he can't just lower rates on his own. He still needs to convince the rest of the voting committee. And with several existing members still in place, big changes likely won't happen overnight. So if rate cuts are off the table for now, what does that actually mean for your house, your portfolio, and your crypto? Let's break down each one, because the housing market in particular is doing something pretty strange right now. Higher for longer interest rates are already reshaping the housing market, but not in the way you'd expect. Sellers are pulling listings off the market at a near-record pace. Why? Because plenty of sellers are still anchored to 2021-era prices, and if buyers won't pay that, many would rather wait it out, especially if they're sitting on a low, locked-in mortgage from a few years ago. Meanwhile, buyers are gaining a bit of leverage. They know if a seller won't budge, they can simply walk away. According to recent housing data, the typical home is up just 0.8% year over year, basically flat. The recovery is on pause. But location matters enormously here. Prices are expected to fall in several formerly hot markets, while more affordable areas in the Midwest are actually seeing prices rise as younger buyers search for realistic price points. Here's the strange paradox. The higher rates go, the more sellers pull their homes off the market. But fewer homes on the market means the remaining homes sell for more. So, prices should be falling faster than they are, but that standoff is keeping them propped up. If you're buying right now, don't be afraid to walk away from a deal, and always shop your loan around. Even a small rate difference can save you thousands over the life of a mortgage. If you're selling, price it realistically from day one. The longer a home sits, the more leverage you lose, and the more buyers assume something's wrong with it. Now let's talk about the asset that's reacting to all of this even harder than housing: Bitcoin. Bitcoin is down nearly 40% from its all-time high, and it dropped another 20% in just the last month alone. A lot of that pressure is being pinned on one company, the largest corporate holder of Bitcoin in the world, which controls a little over 4% of the entire supply. That company built its reputation on a never-sell strategy, so when it quietly sold a small amount of Bitcoin recently, the market didn't shrug it off, it sold off hard. In the big picture, that sale was tiny relative to their total holdings, but it exposed something important. This company buys Bitcoin by issuing shares and paying out a large dividend funded by Bitcoin's price appreciation. If the price keeps rising, the strategy works. If it falls, they may need to issue more shares, diluting existing shareholders, or sell Bitcoin to cover costs, which can push prices down further and create a feedback loop. Beyond that one company, the bigger reason Bitcoin's been struggling is simpler. Money and attention have been chasing IPOs and AI stocks instead. Forecasts on where Bitcoin goes next are all over the map. Some analysts think it could fall further before year-end. Others believe the bottom is already behind us, with longer-term price targets still well above where it sits today. Realistically, expect more choppy, unpredictable price action until sentiment shifts back toward crypto. So, with all of that, inflation running hot, a brand new Fed chair signaling higher rates, an overvalued stock market, a frozen housing standoff, and Bitcoin getting hit from every direction, what should you actually do? Let's wrap this up. Here's the honest take. A lot of the reaction to this Fed shift is more dramatic than the situation calls for. The new chair inherited an economy with hot inflation, an oil-driven price shock, and a deeply divided committee. None of that is his fault, and none of it gets fixed overnight. The one thing that matters most over the next month is whether tensions in the Middle East cool down. If oil prices come back to earth, inflation eases, and rate cuts come back on the table. If something disrupts that, all bets are off. So what can you actually control? Not the Fed, not oil prices, not geopolitics. What you can control is staying diversified instead of chasing whatever's hot, keeping a cash buffer so you're not forced to sell at a bad time, and continuing to invest consistently instead of trying to perfectly time the bottom. Because honestly, nobody, including the so-called experts, predicted this exact combination of events even a few weeks ago. If you found this breakdown useful, that's exactly the kind of content I do here every week, cutting through the noise to explain what's actually happening with your money. Hit subscribe so you don't miss the next one, drop a like if this helped you understand what's going on, and let me know in the comments, are you more worried about inflation or about the stock market being overvalued? I read every comment, so I'll see you down there. Thanks so much for watching, and I'll catch you in the next video.